fall in crude prices, there could be an impact on gas prices as well going forward. That would not bode well for both the oil and gas production segment as well. For oil marketing companies, of course, this is a significant reduction that they see in their raw material costs, and this is something that will aid their refining segment. There was a UBS note recently which indicated that OMC's integrated, that is refining and marketing segment margins, could see an improvement by 2 rupees per litre quarter on quarter in the September quarter. They are already at elevated levels, currently at around 16.2 to 17 rupees per litre for both petrol and diesel, and this compares with an average of 10.5 to 11.7 rupees per litre that they've seen earlier. So there is definitely a positive trend coming in for OMCs here.
All right, just a couple of seconds to go for market open, so we'll keep an eye out on all those stocks, Sonal. What do we have? The first couple of rates starting to show up, and we'll have them up for you. The indices, and then we'll go to stocks. So it's a flat start. So 25,000 around is where the Nifty is starting, 25.25, and the Sensex is starting at about 81,800. So those are the Nifty and Sensex rates. Nifty Bank starts a little more pronouncedly lower. That's a 0.25% cut, 51,140, 150. That's what you have. Mid-cap index is up about 0.15. 59,100 is where the mid-cap index is trading at. I mean, at least opening at. Market breadth is too early, but 4:1 in favor of advances right out of the gates. So it's looking good. And it's absolutely split down the middle as far as the Nifty heat map is concerned. I mean, same number of gainers, same number of losers, but that'll start to change up as we go along. 30 points lower on the Nifty, so we're around the 25,000 level at this point.
Well, let's get to the winners then. The top gainer is BPCL. It's up nearly 2%. HPCL2 has rallied harder, 3.5%. Given the decline in crude prices, the consumers are waiting when will our pump prices come down. Asian Paints also tops the chart. That's rallying now. It opened up higher and now inching towards a 2% gain, a beneficiary of the decline in crude prices. Power names like Bajaj Auto and Power Grid have a green tick at the beginning. Bajaj Auto has been moving well. It's 62%. It's the top gainer on a year-to-date basis in Bajaj Auto, and this morning too, it's opened up with strength. Couple of IT names, TCS, Tech Mahindra, HCL Tech, have opened up in the green. The gains are not much, but it's a positive start to trade. On the way down, it's Tata Motors. That's straight away fallen close to about 3%. There is a UBS note where they're saying that JLR discount spike and should investors worry. So that's the title of the report, and that's pushed the stock down. 825 is the target price set by UBS on Tata Motors, and Tata Motors is on the verge of breaching 1,000 rupees on the way down. ONGC2 takes a big hit. You've got cuts in, State Bank of India, ICICI Banks. Banks are a bit on the back foot. Keep your eye on life insurance companies. Remember HDFC Life, they've been the biggest drags this week. So HDFC Life, again, opens up in the red. It's down about 1/3 of a percentage point. And for this week now, it's down nearly 5%. But the mid-cap index at least has a green color.
Well, that's right, Reva. You have a big pullback actually in Tata Motors. You have the UBS note that came in earlier today. They have a sell rating with target price of 825. So, that stock, in fact, is one of the biggest losers on the Nifty. The crude sensitives, ONGC is lower, Oil India is lower. On the flip side, your BPCL and Asian Paints, both of them are higher in trade. Piramal Pharma, that's one stock from the broader markets. It's moving from strength to strength. It was an underperformer post-listing. I think it listed at around 170, 180 rupees. Then it corrected to around 80 rupees. And currently, it's pulled back all of those losses. It's at around 240 rupees. So Piramal Pharma is the stock that we're talking about. Good move is what we're seeing on that front. Other stocks that are losing out today, you have Olympic Pharma that's down close to around 2.5%. While on the flip side, the Vodafone Idea is going to survive. They're going to get the required money. Then Indus Stars could do well. And Indus Stars, after correcting a fair bit, it's pulled back close to around 2% in today's trading session. Zomato continues to run along. We had pointed this out a couple of sessions ago that if it's going to come to the F&O, it could possibly make it to the Nifty in the next review. That will be in early 2025. For the time being, big volumes out there, up 1.5%.
Okay, well, so a fair bit opening up and, starting to come through. But at least at a headline level, at an index level, there isn't very much at all which we can see. Maybe just look at, the other sort of pharma names from yesterday as well, right? I mean, so Piramal we were discussing in the morning. Divi's, for example, was the big Nifty gainer, was up about 4%. There was Jubilant, which was another sort of big mover, and so on and so forth. So Divi's is flat, Piramal is higher, Jubilant Pharma Nova is up about 1.6% at this stage. Look at Paytm. That was, of course, that's been the other mover. It came off the day's highest level, but I think, worth looking at where that is. 653 is turning green as we speak. So that is another one. Maybe also quickly look at the life insurance companies, right? I mean, HDFC Life and SBI Life, if there's any momentum or follow through after what we saw yesterday, and we'll take a look at that one as well. So HDFC Life is down to another 0.65 odd percent, and I think SBI Life is ticking slightly lower, but these are small changes, nothing of consequence, at least at this point in time. All right, Gautam Shah is a market master of the day, founder and chief strategist at Goldilocks Premium Research. Gautam, good to have you with us here. Thank you for your time. I think the story is the same, right? Buying the dips has worked and it continues to work. But just a quick snapshot view. Where are we at? We had a view earlier from Lawrence Belanco, who was kind of saying that maybe it's getting a little more murkier now. We are kind of flagging momentum. But I don't know if you agree with that, or do you think this is a go-go market still? Go on.
Good morning, Prashant. Well, I think it's dangerous to believe that every single dip in a bull market will get bought into, because at some point of time it will reverse, and when it reverses, it doesn't announce and come. Having said that, if you really look at the setup over the last few weeks, what you'll realize is that the market is looking a little exhausted. I think the up days are not as strong in terms of momentum and participation. In fact, the down days last week has been a lot more stronger. And that makes me believe that there is a battle between domestic liquidity and valuations and global headwinds. Until this battle continues, I don't think the market is going up significantly or going down significantly. So I think the numbers are very clear from a short-term perspective. 25,150, I think, is an important barrier, which we hit yesterday at the highs. And 25,500, 600, according to me, is a sort of a ceiling for now. And I'm not looking at any number beyond the same for the time being. On the downside, I think the 24,800 area is an important support. If that were to break at any point of time, you could possibly see a 5% dip on the Nifty. And as I've said multiple times in the past, 5% is the new 10%. So given that, it looks like as if the indices are just going to broadly stay in a range, oscillate between greed and fear, not go up much, not go down much. And this is still a very sector specific and stock specific market, because money has to flow into some pockets. And I think we are seeing IT, pharma, FMCG, chemicals doing extremely well. So those are the pockets to focus on. And basically the idea is to stay away from the recent outperformers.
Gautam, morning. Rima here. So in IT, pharma, FMCG, which are likely to, see money flow in and stocks do well, which stocks do you like?
Well, I think the entire basket has done very well. I mean, look at the move in Infosys, TCS, HCL Tech, Tech Mahindra. And mind you, IT has come out of a range after almost 2 years. I think the high was tested in 2021, and that number was removed a month back. So I do see a lot more strength, possibly 12 to 15% upside on the IT index. And I think that's the issue, because for the Nifty itself, the leadership is somehow gone, because apart from IT, banks are not doing too well. Reliance has lost its way quite a bit. So just IT index cannot keep propelling the Nifty higher. But as an opportunity, I do see many of these top line stocks do exceedingly well even from here. Add to it pharma. I think what a beautiful structural trend that sector has seen, and I don't see any signs of topping out there as well. So I think both these sectors, which are historically known to be defensives, will continue to do well. And the good thing is they can do well in the good times for the index and the bad times for the index.
Hi, Gautam. Good morning and good to see you win. In fact, pharma has been the big outperformer of this year. The index is up, I think, more than 35%. So big move is what we're seeing. Under-owned, batted out, and some of the stocks have come back. But Gautam, before we get back to equities, I wanted your view on a couple of commodities. On crude, that's Brent crude is below $70 per barrel this morning. Where do you see that number headed? And also gold, which has been twinkling of late, holding at around $25 an ounce, $2,500 an ounce. View on both these two?
Yeah, I think it's a good point. I think that's the problem really, because there are some global headwinds, and that's been validated by what has happened on NYMEX crude in the last few weeks. Mind you, for almost 12 months, NYMEX crude was in this band of about 70 on the downside and 95 on the upside. breaking 70 only means that there is a problem. There could be a problem economic-wise. And I think with the follow-up that you've seen in the last 5 days, it does look as if NYMEX crude is going significantly lower from here, maybe another 10, 12, 15% downside, which I think will be a little problematic. On the other hand, if you look at gold and silver, they remain absolutely steady on the charts. In fact, I do believe that gold will go on to do very, very big things over the next 6 to 12 months. And that's been our stand for the last 18 months. So I think that's clearly an opportunity. But to add to that, I think the US markets for the first time in a year are looking a little wobbly on the charts. I mean, the NASDAQ is losing its leadership with what's happened with NVIDIA, with all talks around what Warren Buffett has done to Apple and his cash positions. And the price action itself has not been all that encouraging. So when you have a slightly negative US market action, it puts pressure on Indian markets, which are anyway trading on very high valuations. And because of the domestic liquidity and these global factors that I just highlighted, I think the market will broadly be in the range, and that's the best thing for us to happen right now.
On gold, you said is poised to do big things. You want to put some levels to it, Gautam?
Yeah, sure. I think our short-term working number on gold has been about 2650. Now, that's not far away, but we've been riding it right from 1900 levels. But if you have to talk medium-term, long-term, I think over the next 12 to 18 months, you will see a $33.50 on gold, which is a nice 25% rally from where we are. And I do see a similar 25 to 30% upside on silver coming in. So at levels of 28.5, I think the downside is very limited and the upside is large. So it's these are structural charts and they have followed up beautifully. They've handled the bad times beautifully. So I think that's where capital should be committed to a larger extent.
Sorry.
And you said crude prices can fall 10 to 15%. So on Brent, we're looking at $60 per barrel?
Yes, and lower.
And lower. And what does that mean then for, say, paint companies or any of these oil marketing companies or ONGC Oil India, conversely, on the way down?
Well, I think you have to take a stock-specific call there. But I think the two key points, one is crude going and sustaining below 70 on NYMEX means that there is a problem globally, because otherwise you would not have seen this mega breakdown that has happened in the last 10 days. So that's point number one. Point number two, many of the outperformers of the past, the auto sector, the capital goods, PSU, real estate, they've all lost their leadership. If you look at the last 2.5 months, they've all been sideways. And as the Nifty hit levels of 25,000 and beyond, these sectors haven't participated. So clearly smart money has gradually moved out of these spaces and moved into other spaces.
Just to I want to just go back to what you began by saying. So I'm paraphrasing here, and correct me if I'm wrong. What you're saying is this is still a bull market, but near-term risk reward is a bit uncertain. So be a little careful. Am I paraphrasing you correctly?
Yeah, absolutely. I think medium term, long term, we remain absolutely bullish. I think there are no signs of topping out on the charts. It's just that we've come to a point where the short term studies are not in sync with the price action anymore. I think the market needs a 5 to 7% kind of a cool off. Whenever it happens, it might not happen maybe in the next 2 weeks. But I think the last quarter of the calendar year, October to December, is when one will have to be a little conservative. Mind you, in 2021 and 22, we had a similar scenario where for about 6 to 8 months, small caps went into a 12-13% correction, and then they came back strongly. So it's just that be careful what you're buying at these prices. I mean, stay away from anything that is narrative based, that is story based, and that is richly valued. Those are the pockets you want to stay away from. There is still a lot of pockets which offer value, and I think one could commit into that. I think NBFCs is one space that we've been liking. Chemicals is one space that we've been liking. Metals also to a certain extent. I think one can commit capital into them.
Right. No, I get that. So just a quick word, in PSUs, right? Are we starting to see momentum there flagging, taking a decisive backseat, Gautam?
Momentum has been taking a backseat for a couple of months now. I mean, you don't see PSU stocks move with the Nifty, and that's very clear when we see the ratio charts that the outperformance is absolutely gone. It's just that the indices are steady and therefore PSU stocks are not correcting much. But if the indices were to get into a bit of a correction, then I think PSU stocks will come under pressure. Again, long term, all is well because they are still not in fraud territory, or exuberance territory in some sense. But near term, I think they require another 5-7%, maybe even a 10% dip before things get back on track.
Gautam, you said you like select metal stocks or metal names. What do you like out there? Because this Chinese data is worrying me a lot, particularly the export data. Yesterday, there was this headline that Chinese exports beat estimates. Most worrying aspect for me. That means they're not consuming enough. But, normally when things go so bad, it normally hits a trough. So what do you like from there?
Yeah, that's true. I think even when I speak to a lot of top managements in the metal space, the message is that on the ground, things are not all that good. But the stock markets are a discounting mechanism, and I think they have discounted a lot into the future. So I think a lot of the current negatives are already in the price. And if you look at the metals index itself, I think 8,500 on the downside and 9,700 on the upside is clearly the band. Whenever that breakout past 96, 9,700 comes, I think it'll be an opportunity. And mind you, metals as an index has doubled over the last 12 months. So it needed that consolidation. It's happened in the last 3 months. And I think many of these top stocks, JSW Steel, JSPL, Nalco, SAIL, Vedanta, Hindalco, I think they all look very good opportunities from a 6 to 12 month perspective.
No, I get that. So, Gautam, would you want to name 3-4 sort of ideas you can leave with our viewers on a positional basis?
Well, I think, as I said, among the top sectors, if you look at IT, I think TCS, HCL Tech, Tech Mahindra have been right on top of our list. In the FMCG space, I think ITC and HUL have been on top of our list for a while now. In the NBFC space, I think Bajaj Finserv and Bajaj Finance, I think, offer great value from a charts perspective and from a valuation perspective. And I see a lot of comfort in terms of margin of safety. And in the pharma space, I think stocks like Dr. Reddy's, Cipla, Sun Pharma still offer great value. So honestly, I'm just sticking to top quality right now. I think I don't want to go even into grade B and grade C, given the fact that we seem to be at very elevated levels.
Okay, well, it's a large cap list, right? Thank you very much, Gautam, and thank you for joining us. Clear views and a bit of caution on board as well, at least in the near term, as far as markets are concerned. So there's Gautam Shah, Goldilocks, with his thoughts. 30 points lower on the Nifty now. We're at about 25,010, and it's a bit sort of down and out. 1,400 stocks are higher and about 900 stocks are lower. So market breadth is still positive, although it's not. I mean, of course, nothing like what we had yesterday. Suzlon has climbed the leaderboard in terms of volumes. It's up 5%. I think that's the daily limit. And it's got very large volumes. And number 2 is Piramal Pharma with a 4% pop. There is Century Textiles, which is up about 3.5%. EPAC Durables was another one which moved up very sharply yesterday. And it continues its move higher. So 320. 4 days back, stock was at about 260. So that's a fast mover we've had here. And actually, that's about it. Volume-wise, not very much else is really showing up on the screen. Tata Motors is down 4. We highlighted that. Premier Energy, that was down about 4%. I think it's had a tremendous move since listing early last week. It's down another 2%. And of course, then you get to the oil stocks, Oil India and ONGC as well. So that sort of gives us a cue to talk more about oil prices and beneficiary and who gets hurt, etc. But let's summarize what's happening with oil itself, right? We've fallen under $70 a barrel, 15%, I think, in the last 10 days or so. That's very sharp. Hormuz has looked at what's driving this and what are the big views coming in from the global strategists. Hormuz, over to you.
You know, a lot can happen in a year, right? Around the same time last year, we were worried about oil prices hitting $100 a barrel, and now we are talking about oil prices correcting almost 15% in the last 10 trading sessions, and that is exactly what has transpired, with Brent now down almost 30% from the highs of around $97 that it had hit on the September of 28th last year. And since then, it's been in this corrective mode, and in this quarter itself, so far, it's now in almost down 20% in this July to September period so far, which is the worst quarterly drop since the third quarter of 2022. This shows the kind of correction that we've seen in the oil prices. Now, what is causing this? There have been a lot of demand concerns, particularly from US and China, which are the top 2 consumers, of course, and the top where the demand maximum originates from. And of course, there is this uncertainty over what the OPEC Plus is likely to do as well. Now, considering this fall in oil prices, OPEC Plus had already postponed their already planned output hikes, which were scheduled to begin from October October by around 2 months. But then there is this uncertainty because this is not a decisive move that OPEC has taken, and there are plans to increase output by at least 2 million barrels a day by the end of next year, and that is also not giving any form of cushion to the oil prices. Now, what can support them on the downside? Well, there have been reports that came out yesterday that there was a rise in the US stockpiles. There is hurricane season going on in the US. There is one storm that is likely to make landfall today and more in the offing as well. And of course, there is any further output cut announcements that OPEC does end up making in the view of this falling prices. Now, what are strategists saying? JP Morgan believes that they expect Brent to average around $75 a barrel next year, but they expect the prices to dip to the lower 60s by the end of the year. And what Goldman Sachs also believes, for the next quarter they expect the Brent to average around $77, but their range that they have between 70 to 85, that still remains skewed to the downside. And Citi also believes that Brent is on track to hit their target of low 70s by the end of 2024. And OPEC Plus is now caught in a very vicious circle of trying to sacrifice market share in order to defend price. So all in all, not good going for oil prices right now. There does not seem to be a floor in the offing.
All right, Hormuz, thank you very much for that. So those are some top global banks with their views there. Let's also listen to Hardeep Singh Puri, right, the energy oil minister, and he was speaking with my colleague Shireen Ban earlier at the India Energy Transition Summit. His thoughts on where oil prices were holding at that point. Listen in.
Ultimately, demand and supply.
Yes.
And I was very encouraged by your reference just now to OPEC having decided not to undertake production cuts. Hey, wait a minute. We had a production daily of 102 million barrels per day.
Yes.
They reduced their production by 5 million. I've seen statements by OPEC Plus to the effect that they will unwind those production cuts. Now, I'm on your side. If after the drop in oil prices, will they still, and I'm not tempting anybody, but I'd like to see, because they've told me at a bilateral level that they will, unwind. There are two things that I'm interested in. There is more oil in the market available. There's no shortage of availability. The price levels are maintained essentially on account of artificial holding back.
Right.
If the total amount of oil which is available in the world is allowed to be available, then I think we'd be in a slightly more comfortable situation. We have so far, Shireen, navigated the terrain reasonably well.
You know, the oil minister's comments actually seem very prophetic, because he made those comments on the 5th of September. He said oil prices are being held up artificially. Guess what? Since then, oil prices are down about $4. That is, of course, Hardeep Singh Puri. We have Peter McGuire, CEO of Exim Australia. We also have Somit Pokarna, Vice President Research at Kodak Securities. So we'll get you sort of a global view on this and a local sense in terms of who benefits and who gets hurt. Gentlemen, good morning. Peter, if I can start with you. That was, of course, the India oil minister. Well, prices are down, and down how? So what's going on? Is this, should we, in terms of how markets are looking at this, is this an indication of weakening underlying demand? What's your sense, Peter?
Well, good morning, Prashad. I think a couple of things. Yes, it's very hard to argue against the oil minister, because quite simply, the way he describes it and the rhetoric he uses is so matter-of-fact. This market is in free fall in a lot of ways. It's taken everyone, I think, by surprise. If you're looking at what happened a year ago and where we are today, you've got a market down $30. There seems to be global weakness if you're looking at the likes of China. And the situation, I think, is plenty of supply. If OPEC were to move forward and increase their supply come end of year, and I know they've pushed it out, but if they were to do something like that, you would see, I would think, probably weaker prices than what we have at the moment. So it seems to be a race to the bottom, and it's a time to be short from a trading mentality, and it's incredibly volatile with the whipsawing that we see on nearly within a weekly basis.
So, Peter, how much lower do we go? Say on Brent, do we hit $60 per barrel? What about base metals? Do you have any targets in mind, any levels that one should keep an eye out on?
If you look at iron ore, we're at $90, and it's lower today than what it was over the last 5 years, Reema. So There's the first part of it. You're looking at copper still sitting at that 89 to 9,000 a metric ton. As far as oil, look, if you're sitting at 69, 62, if you asked me a year ago, you said, Pete, it's going to be down $30, I would have said, Reema, you're dreaming. But I tell you what, you can't say that because the market is the market, and the war premium stripped out, geopolitical, even though you've got these ongoing sagas, there doesn't seem to be anything to push markets higher. So maybe you're looking at 65. I'll go out there and say Brent's got the capacity to hit 65, but we've got to have a closer look at it once it is there and what the general themes are across the whole fabric of the oil market.
Peter, since you briefly mentioned about the ferrous space, where do you see Chinese steel prices headed? You know, they've seen a sharp decline, weak data, weak consumption. They're exporting more. So what's the level you're looking at on Chinese HRC prices? And even iron ore, the lowest we've seen in multiple years, at around $90 per ton. Where is that one headed?
Well, Nigel, I think, and it's good to see you, I think you've got to say 85's got to be the next target, you know, but when you're looking at it over a chart, it's just hard to argue against because the downside or the downdraft has been so dramatic. There's the first part, and it's certainly not doing anything, you know, wonderful for the Australian miners. So let's park that there. As far as Chinese demand and what you're going as far as those, you know, those finished goods, I think it's going to be softer prices. So that's where we sit as far as the base metals and ferrous. And I think one's got to be short to probably look at it from a trading perspective.
So, Peter, just one final question then, and then we'll get chatting with Sumit also about the Indian markets and the implications. Apart from China, what else is driving the weaker demand? Are there any other geographies where we're seeing slowing demand?
Well, Reema, you'd have to say across the fabric of Asia, a lot of that is a little bit softer, and certainly if you're looking into the United States. But the overall, I think, picture is that you've had there was supply issues that OPEC took into consideration post-COVID, and now that's coming through to the other side of it where you've got plenty of production, you've got Libya back online, you've got a number of those other OPEC producers all wanting a piece of the apple. And you can't argue from the numbers. When you're thinking about the whole scheme of things, you're at 102 million plus barrels a day of consumption. So it's certainly not weak, but the story at the moment is softer prices and the potential to go lower yet.
Got that. Peter, we're going to come back to you. Let's welcome in Sumit Pokarna as well. He's with Kotak Securities. Sumit, good morning. Good to have you here. So you heard the sort of global piece from Peter. So what are implications? Who are the big sort of outright beneficiaries and who gets hurt from a trading perspective for those who are watching?
Yeah. So every coin has two sides. Definitely falling crude oil prices is positive from India's point of view, and mainly because India's dependency on imported crude is very high. So to that extent, it is positive from current account deficit, fiscal deficit. It is also positive from companies like which are into retail fuel like OMCs, oil marketing companies, HPCL, BPCL, IOC. And then obviously paint companies and lubricant companies are also going to get benefited, but with a lag. So to that is on the positive side. But if I look on the other side of the coin, when the crude is falling drastically, that means some slowdown is visible in the global economy. And particularly China, the demand is not there. And we all know that China is the world's largest oil importer. So on the flip side, if any macro slowdown happens globally, and if that happens, then India will not remain immune to that extent. However, there is a demand-supply mismatch. The market is also anticipating that OPEC had guided for a production increase. So the supply, if it's because of the supply side, then I don't have any worry. But if it's because from the demand side, then I am really worried from maybe 6 months down the line what happens to the global economy.
Sumit, you started with this being a macro positive. What is the average sort of import price now? Because we are almost about 50% of what we import as a country comes from Russian oil, which I think is, in any case, a price much lower than where I mean, Brent is at, or the Indian basket of crude, etc. is. So I just wanted to, I mean, do you have that number? There used to be that, yeah, go on.
Right. That number is not handy right now. Yeah, but definitely we are getting benefited. But need to be noted here that once the crude will fall down, the discounts which we were getting earlier might also fall down.
Yeah. No, or maybe the discounts remain the same, so you're essentially benefiting, right? Because the price for Russian oil is also lower then, as compared to where... Yeah.
Right. So $60 comes anyway, it is big positive, irrespective of discounts. If the crude falls to 60, anyway, we are getting big time benefit from the fall in the general markets. If you look at the other side of it, obviously oil explorers like ONGC and Oil India, they are going to get impacted majorly. And we have continuously been highlighting that because we are seeing the demand pressure globally. So we have seen that ONGC is, and we have been negative on both the stocks, ONGC and Oil India. So far, oil marketing companies are concerned. There I would like to highlight that obviously their marketing margins have improved drastically in this quarter to date.
Sumit, just a quick point. Do you think we'll see fuel price cuts by the government? Or because one argument is if you cut prices at the pump, states will increase VAT. So what's the point? Or you think the centre may actually cut excise duty?
Yeah, so that is a very difficult question to answer, to be very frank, but that all depends because we are heading towards 2 state elections also. So how does the government play? I would like to myself watch for the same.
Okay. All right.
So Sumit, just if prices stay where they are right now, what would be the marketing margins for oil marketing companies in Q2 versus Q1? And what's the earnings growth then that we're looking at?
Yeah. So oil marketing companies, if you look at diesel margins, which have increased by almost 46% in Q2 till date as compared to Q1 of last quarter, FY25. So that is a significant improvement, and currently average is coming to 5 rupees 10 paisa per litre for diesel. And coming to gasoline, that is petrol, the margins have been very, very attractive. They have increased by 88%. They are currently average out to 7 rupees 30 paisa as compared to 3.9 rupees in the previous quarter.
Okay, all right. Thanks a lot, Peter, as well as Sumit, for joining in and giving us your inputs on this important oil price move that we are seeing. Wishing you guys a good day ahead. Well, for the time being, though, we'll slip into a short break. On the other side, we'll connect with Pavitra Shankar, the MD of Brigade Enterprises. Stay with us. Well, Brigade Enterprises, the next management on the show. The stock has surged 47% in 2024 so far. The company recently raised 1,500 crore rupees by selling equity to institutional investors as part of the strategy to expand their business. To discuss this and more, how demand trends as well, we're joined by Pavitra Shankar, the MD of the company. Hi, Pavitra. Good morning. Always good to see you, Ben. Let's start with basically this fundraise, the QIP of 1,500 crores. How do you plan on utilizing it?
Hi, good morning. Yeah, we're very happy with the outcome of our QIP. We are looking to utilize the funds basically as growth capital. We are seeing that across the sector, all of the different domains, residential, office, retail, and hospitality that we're in are doing well. And we're looking to basically capitalize on that trend. Specifically, we're looking to use the growth capital for the residential sector.
Any part of this will be used to reduce your debt? Are you looking at debt reduction? Yeah.
On the residential sector, we've been running it debt-free for a few years now. We do employ debt in the company, mostly for CapEx to grow our lease rental portfolio. And once it's leased out, we used securitized, we securitize the lease rentals, and we basically have a very low cost of debt across the board. So predominantly it is for growth, but there will be some recycling as well.
Pavitra, hi, good morning. Prashant here. The underlying business, how is it panning out in Q2, Pavitra? I think in Q1 we did see a bit of a fall in terms of pre-sales and overall volumes. Have you seen recovery in Q2? And what is the growth guidance for the full year 25?
So in Q1, it wasn't just at Brigade, but multiple other of our peers as well did show slightly lower numbers. Those of us, especially with a lot of projects in Karnataka, face some slowness in approvals. Not just Karnataka, Tamil Nadu, Telangana, a lot of the South Indian states, we face some slowness due to elections and therefore some impact on approvals. But a lot of that has been getting resolved during Q2. In this kind of market, a lot of the sales numbers are driven by launches, especially. So that's kind of why the Q1 numbers looked a little lower. But I would also say that it's reflective of what is able to come in for launch. So what all the indications that we have on ground is still that demand is very good. We're still getting a lot of walk-ins, responses to our digital marketing campaigns, and so on. So we're quite confident that Q2 will be a lot better than Q1, and going forward as well for the rest of the year, for the financial year. It is to be supported by launches. We have about 12 million square feet coming up in launches for the next 4 quarters. And a lot of that should translate into sales for the numbers this year. So should be looking at a good, good FY25 as well.
You want to quantify that, Pavitra? What would good mean? The start has been a little bit softish for reasons you mentioned. But for the year, since you're seeing a recovery in Q2, you have so many launches as well, what should we end FY25 at?
So Brigade usually doesn't give guidance. We try to aim for a 15 to 20% year-over-year growth, and we're striving hard for that. As long as the launches are coming in, we're very confident of the sales.
So 12 million of launches over the next 4 quarters. How much of that will come in Q2?
So we are working on maybe another 1.5 to 2 million square feet to be launched in Q2.
Okay, all right. Let's focus a little bit on pricing then. You had that new Chennai project that you launched as well. So as a geography, how has Chennai been in comparison to, say, your core market of Bengaluru? And could you give us pricing trends in both these 2 markets as well?
Sure. So just in terms of overall market size, Bangalore absorbs about 50 million square feet of residential space annually. That number is still at around the 2013, 2014 level. So as a market, we're sort of just back up to where we were 10 years ago. Chennai is a little smaller than that. It's about 55 to 60% of the size of Bangalore. While in Bangalore, we enjoy a leadership position. In Chennai, that's one market that we have done a lot of groundwork. There has been substantial business development in Chennai for Brigade as well. And over the coming years, we'll be seeing a lot more residential projects coming up in Chennai. As a market, it was historically priced better than Bangalore and say higher than Bangalore. But in the last couple of years, we've seen dramatic price increase in Bangalore. So I would say it's sort of neck and neck right now. It really depends on the different sub-markets where we're launching projects. Our recent project that you were mentioning, Brigade Icon on Mount Road, that's done extremely well. We launched that in Q1. The RERA approvals came in early in Q2, and that has done extremely well. The average pricing there is about 27,000 rupees plus per square foot, so a 7 to 8 crore ticket size. So it's a very different project for Chennai, and a very different project for Brigade as well. So we're excited for the prospect of residential segment in Chennai.
Just to push that point on pricing, I was talking to a banker. I mean, and he was saying that, and this is not about Bangalore, or he was saying that across larger cities, right, price-led gain for land is a different issue, but for flats, that maybe we're kind of we past the peak. So that demand, I mean, actually, if people want to buy a home to live in, that's of course that demand, as you said, is very solid, but in a way, investment-led demand with an eye on potential gains that prices will go up, that's kind of maxed out. That was his opinion. I don't know if you have a view, Pavitra. Not just, I mean, I'm not talking about Brigade, but generally. Yeah.
Yeah. So in many of the key markets, top markets in the country, we have seen your double-digit price growth, quite eye-watering, actually. I would say most of that is probably behind us. It would not be right for us to keep expecting, substantial price increases where people are, in the past couple of years, it's been 20-30% increases. I don't think that is sustainable. And, we are still happy. I would say people in general should be happy with, a 5 to 6% growth as well. This is a real estate sector that we're talking about. While many people look at it as an investment, it is still predominantly in the residential side. It is predominantly where people expect to take possession, utilize that space, live there, etc. So in our own portfolio, we have a very high percentage of end users, and therefore we see that demand to be very stable. So I would say there is still some investor appetite for real estate because people should be looking, in a medium to long-term time frame if they're looking at the sector. There is some speculative demand, which I do hope remains minimal, because that would ensure that the cycle is a little more stable and ends up being longer than it can otherwise be.
Very quickly, Pavitra, on the hospitality portfolio, the occupancy went up, but the ARR was more or less flattish in the first quarter. You had guided for a 10% increase for the year. Do you think that's still doable? Is that still on the cards?
Yes, I think so. There's a lot of seasonality in hospitality. Q1 can generally be a little slower, but coming up with all of the festivals and conference season and so on, I think we should still be on track for that.
Okay, thank you very much, Pavitra, for joining in, and wish you all the very best. Now, moving on, the Ministry of New and Renewable Energy recently notified draft norms for an approved list of models and manufacturers, ALMM, for solar cells. It's proposed to be effective only April of 2026. These are draft norms. Now, Kotak Institutional Equities in their notes says that this mandate is a potential positive for cell manufacturers. To discuss the opportunity, we have with us Mohammed Saif, partner of Power and Utilities Practice at EY, joining in. Thank you very much, Mohammed, for joining in. Share your initial thoughts on this draft notification. What is the total addressable market, and who would be the key players in India who would benefit, listed and unlisted?
So we have to first understand the ALMM background. This, before the intention of getting to the cell manufacturers, Government of India has already notified in 2019 the list for module manufacturers, which is, the integrated module, which has all the cells already intact. Now, this scheme went on through a process of updation. There was a pause last year, but as of now, if you see, we have almost more than 90 manufacturers who have already enlisted here. The major benefit that I see from this scheme is that most domestic manufacturers are going to have a very strong quality focus, given that we are going to be envisaged as one of the global manufacturing hub in solar very soon. So this scheme is a downstream upgrade of the earlier module manufacturer listing, where the cell manufacturers, which is the prime component of the module, are also being asked to, come into this empanelment and provide cells, but basis a very specific standard of quality. Now, the benefit that I'm seeing, as of now, if you look at the Indian cell market, it would be close to 7 gigawatt of manufacturing as compared to the module market, which would be somewhere around close to 70 gigawatt. When this ALMM would ensure that we would have a lot of manufacturers getting in, trying to compete in the solar cell manufacturing also, as has happened over the years in the module manufacturing. So if you ask me the addressable market, I mean, I can provide sort of an initial estimate, but somewhere till 2030, we are looking at this market of solar cell to go almost 7 to 8 times what it is today. Would be somewhere around 49 to 50 gigawatt of manufacturing.
7 to 8 times by 2030 for cells.
Yes. What it is today, it is somewhere around 7 gigawatt.
7 gigawatt is cell capacity in India, and module is 70.
Module is around.
Yeah, and so far basically you had the module and then cells were imported and then put together.
Right.
You'd expect.
Right.
Yeah.
So what was happening till date was, while you had the module manufacturers which were enlisted, they had the choice of going overseas to source the cells. Now, with this step, from 2026, April 1st, what Government of India is saying is that the cell manufacturing and the sourcing by for all projects which are under the government scheme and even open access C&I consumers would be through domestic manufacturing of cells.
Okay. And so this completely, so globally, Mr. Saif, there is a big glut, right? And prices have come off very sharply. So we with these policies, we are completely insulated. We will remain insulated?
So see, we have to also understand the complete supply chain when we talk about solar cells, solar modules. But before that, you also have ingots, wafers, etc. We still would be depending a lot when you talk about the raw material for solar cells. That is a reality. But I believe in a longer term, when the domestic manufacturing would start maturing, I'm sure the supply chain overseas would also start getting, controlled in a better way. As of now, you're right. The supply chain would primarily be dependent upon the global cues.
So you'd make the cell here, and what goes? So there is, but we're dependent on import of wafers in a very big way, right?
Correct.
To what degree, and if prices there come off, then what does it do to, the end product?
So you have to look at it that at any point of time, whenever someone is trying to develop a solar project, the cost of the module depends upon the price trends in the global market for the raw material. So you can't predict that, but yes, it is, cyclical. Depends upon a lot of factors, including the geopolitical things that are happening. So you can't predict that in a nutshell, but yes, it is coming down. If you look at the overall trend for the last 6-7 years, that is what best. But yes, controlled by foreign players as of now, if you talk about the raw material.
Okay, and if viewers who are watching and potentially investors, what part of the value chain should they focus on to invest into?
Apart from solar module and cells, or you're talking about?
Those included. What should they look at?
Right. So
actually, utilities who are putting all of this together and generating power, should they look at component makers, module cells? Which part?
So if you see, as I mentioned, that while the module manufacturing is quite getting matured, the cell manufacturing is something which actually has a very strong market when you talk about domestic manufacturing. Obviously, this would require a lot of supply chain tie-ups globally, but that again, and with a focus on this ALMM in 2026, I think the next 2 years are going to see a lot of investments in solar cell.
All right, fair enough. We'll leave it there. Mr. Saif, a quick primer of a discussion. I think we kind of scratched the surface, but hopefully it was useful for viewers. Thank you for joining us and taking us through, some of the details on the solar cell largely solar cells is where the big capacity expansion is going to happen from current 7 gigawatts to 7 to 8 times of that by 2030, according to Mr. Saif there. We'll take a quick commercial break here. Mitesh is going to be with us on specific trading ideas and a look at the market as well. I think we came back into the green for a brief while and we're down again. Stay with us. Okay, welcome back. Market's down about 20. I just want to take a quick look at Paytm, which has moved to the high point of the day. It's up about, it's 3% higher, yeah. And that's sort of started flat, but has since picked up pace. Mitesh is back with us with what he'd want you to do. Mitesh, over to you. What's in your radar?
Prashant, on the indices, not much because they are very quiet and subdued in a range. But some stocks are showing good continuation and breakouts into new highs, and one of them is Dow. I talked about FMCG as a pack a few days back as well. I think they continue to outperform, and Dow now gives you a trading opportunity with a stop below levels of 660 for targets of 690, 95. And the other one which I like is Berger Paints, again showing fresh swing high. So buy here with a stop at 605 for targets of 639.
Thank you very much for that. In a story which could have implications for PSU banks, now the MTNL account is likely to slip into NPA category for most lenders in the current quarter because MTNL has defaulted in its repayments. Ritu joins in for more on that. Ritu.
Well, here you have the case of MTNL, a government-owned entity which has defaulted on its loan repayments and is now asking state-owned lenders to take a significant haircut, a proposal that has not been well received by banks. Now, after missing loan repayments for the past few months, we understand MTNL is expected to slip into the NPA category for most of these lenders in the current quarter. The likes of Union Bank of India and Bank of India have already classified the account as an NPA, and others like State Bank of India, UCO Bank, Punjab National Bank and others are likely to follow in the coming weeks. Now, banks have made it clear to MTNL while they are open to restructuring, including a possible debt-to-equity conversion, but they have firmly rejected any request for a haircut. In fact, MTNL had earlier proposed a repayment plan offering to pay only about 40% of the dues, which we understand banks have turned down. Now, our sources also indicate that lenders have made representations to the Ministry of Finance, stressing that a haircut from a government-owned entity will send a negative message and set a troubling precedent for the industry. Now, keep in mind, collectively, these lenders have an exposure of nearly 7,900 crores to MTNL, and this is where they will have to make higher provisions in the current quarter, while another 27,700 odd crores of the company's debt is in bonds that are backed by a sovereign guarantee, so there's no issue there. Now, the company had disclosed earlier this month that it had defaulted on 519 crores of repayments to Union Bank, Bank of India, SBI, PNB, Punjab and Sind Bank, as well as UCO Bank. And some of these lenders we spoke to said that given MTNL's weak financial position, it will probably require an intervention on external help in the form of capital support from the Government of India for the company to meet its repayment obligations. A meeting of the lenders is expected soon to deliberate on this debt recast plan.
Okay, thank you very much for that. We're going to slip into a very short break with the news that it's absolutely flat on the Nifty and the Sensex. The Nifty, though, holding on to the 25,000 mark. Autos continue to remain under pressure. We'll get into a break. On the other side, an exclusive conversation with the management of L&T. Stay tuned.
Welcome to It's the Economy. Larsen & Toubro recently announced that it is carving out its renewable EPC business out of its overall power T&D vertical and its utilities vertical. What are the reasons for this carve-out? Is there a separate listing being planned, considering that power companies and their utilities are doing so well? What is the state of the Indian and, more importantly, even the global solar power industry where we believe there is overcapacity. For all these questions, I'm joined by Mr. T. Madhav Das, the whole-time director and senior executive vice president in charge of utilities at L&T. Mr. Madhav Das, thank you very much indeed for sparing time for us. First, if you can take us through this carving out of the renewable EPC business as a separate vertical, what does it mean and what is the reason?
Thank you very much, Lata, for having me on the show. And it's a privilege to speak on this. And as we have been incubating this solar business under T&D for pretty long, we have been executing some huge projects. We have been building up our credentials, and in the last few years, we have delivered some marquee projects across international as well as domestic scenario. So this helped us to scale up our operations, build up an ecosystem which can constantly, on a sustainable basis, deliver projects of large scale. This, coupled with the fact that energy transition is one of the key factors which can bring about huge impact on climate change, and with the advancement of huge technology, both in solar and storage batteries, I think the renewable generation has become a reality. It is only going to grow leaps and bounds as we go forward. And hence, since we had incubated this business and we decided to separate it out from the transmission and distribution and give an identity of its own, so that there is clear leadership oversight, there is clear customer proximity. At the same time, there is good amount of skill building that is required to be done, and it brings in a large amount of focus. And the clientele base also is slightly different when compared to the T&D, and hence we decided that this will bring much more focus in the way we deliver these large-scale projects.
No, I take your point, sir. In fact, I was going through some Bloomberg data, and apparently solar and wind together have accounted for 91% of the additional capacity in 2023, and of that, solar itself has accounted for over 70% of the additional capacity. I can imagine that you are getting a lot of business there, but more from the point of view of your investors here, will you look at listing it separately since power companies are doing so well?
No, I think we will still be a part of the infrastructure segment of Larsen & Toubro, and I think there are no immediate plans for listing. However, if you see the way Larsen & Toubro has been going about its green portfolio, we have brought more attention onto the renewable EPC. We have created a green energy segment so that there's clear focus on hydrogen as well as on electrolyzer manufacturing. At the same time, our infrastructure of heavy civil has been doing pump storage. So we have been giving a very great emphasis on green energy, because this is the real way of energy transition which can bring about reality into the world. And hence, within the group of L&T in the infrastructure, there is a clear focus that we should concentrate on green energy, but there's no immediate plans for listing.
Okay. Well, there was another interpretation I heard from the market that probably the renewable business is largely focused abroad and probably in the Middle East, and it has margins which are lower than the margins of the rest of L&T. Is that a reason to carve it out?
No, let me put it this way. The renewables business has grown to a size which requires very heavy oversight. Okay. At the same time, today we have 15 gigawatt of projects under various stages of execution. And hence, it is absolutely necessary that the clients understand that L&T is giving very good focus on this growing business area. That was one part of it. At the same time, we have a large portfolio of this being done in international market where the clients are slightly different and they require a huge focus. So we brought about. On the margins, I don't see any difference. I think we have been doing well, and it is among the L&T portfolio, it is with a reasonable amount of margins. I don't see anything which pulls it down.
Okay, excellent. So that clears some misconceptions then. What about getting into solar module manufacturing itself? The government is giving a lot of incentives there, you know, that AMLL rule, import duty, tariffs. Will that be something that you will venture into?
No, I think that is a decision which we have taken. We will not be getting into solar module manufacturing at this stage. I think our focus is more on green hydrogen electrolyzer manufacturing. And going forward, we are keeping the options open for battery manufacturing, especially for storage, as this will dovetail into the renewable capacity addition, which is along with solar. I think this is something which will be required. So we are keeping our options open on battery there. This is the way we look at it.
Okay. So that at least helps you escape the ups and downs in the solar module industry. But any thoughts on the module industry itself? Not just modules, the entire chain, we believe, is now going through a bit of an overcapacity globally. Does that affect you all in any way in terms of orders, in terms of receivables?
Today, the way it is structured, most of these projects, I think the clients also step in when we do these sort of projects, and hence, I think this, from a client, from a developer point of view, this is a boom time for them because they find the module cost at the lowest, and hence large capacities of jobs are coming up in the Middle East, which we are targeting. And with this overcapacity, the supply also, there is no pressure. So hence the projects are getting executed much faster. So I think there is a upside on this condition. So people are making use of it actually.
Okay. Now, can you tell us how it is impacting order book? While of course execution is very good, does it taper off in terms of order book? What did you all start with in terms of order book in power EPC, and will you likely whittle it down at all?
No, let me put it this way. The T&D segment remains to be the backbone of one of our verticals within L&T, because this was where we incubated the solar business.
Yes.
And the power transmission backlog itself is close to around about, within the infrastructure segment, close to 45 to 50,000 crores of T&D pure, which is spread over India and domestic, leaving the renewables aside.
Okay.
And in renewables, as I told today, we have a clear backlog of 15 gigawatt peak of jobs under construction, which is a very large portfolio in terms of value. And the way we see with the Middle East giving very heavy emphasis on solar projects across the whole Middle East, Government of India giving huge emphasis on 50 to 60 gigawatt pipelines of project every year, or there is sustainable way we see a large number of projects going to come up in the next decade. And hence we see a continuous business available for renewables.
Can you put some numbers? What was the order book like in FY23? What is it likely to grow to?
Okay, I think on that's why I said I am going by gigawatt. I didn't want to put a number.
Fair enough.
Way back in, let me put it this way, when we started this business in 20, we had around about 2 to 3 gigawatt of business going on, and today we have scaled it up to a backlog of around about 15 gigawatt after completing 4 to 5 large projects, and hence this will be the range of order book as we go forward, because there will be continuous commissioning of projects, at the same time an inflow of projects coming in.
Okay. Could you just give numbers for FY24 and FY25? How much is the order book?
So at FY24, it would be, the way I see, we were close to around about 7 to 8 gigawatt, and FY25, we will close at around about 15 gigawatt.
Oh, okay. So that's a sizable, it's a doubling of your order book. Okay. Can you throw some light on the, capacity, demand, supply dynamics in India itself? We just heard murmurs that there is already, solar capacity more than DISCOMs are willing to, evacuate. Is there any fear like that?
See, the way central agencies are going about putting the transmission infrastructure, there is no hesitancy at all. There is a whole plethora of projects which has come out, especially in the last 2 to 3 months. Further, there are at least 30 to 40,000 crores worth transmission line projects already lined up to do the evacuation. And hence, I do not see any hesitancy in terms of the transmission infrastructure not coming up. So that first takes care of the evacuation of projects, which is 100% in pipeline, with some of the HVDC links also being looked upon. So we do see a complete clear pipeline available for the transmission. And then comes the distribution side of it. Yes, on the distribution side, there has to be a little more, modernization to be done to ensure that this reaches the last minute point. And I think green energy is going to be a way of life. So hence, I think this could be a transition phase where people will have to start looking at, most of the industries will start looking at using green energy, and hence the boom will come back. Boom will be there, is what we feel.
Okay. Actually, you are best placed to tell us about, all aspects of the power sector. So if you can give us an idea, by when do you think storage capacity will be sizable in India? By when do you think green hydrogen will become a reality? Are we looking at 3 years out? Are we looking at 5 years out? Just draw the power scene for us say, 3 years from now?
See, the way the capacity addition of storage renewables as well as coal-based nuclear is going on, I think that has got a very clear trajectory as we go forward. We don't see any issue on it. The most key aspect is when we have the variable generation from renewables. The most important thing that happens is to have a clear visibility on the pump storage as well as on the battery storage, because this is something which will ensure that the smoothing of power takes place. And we have been seeing a lot of activities happening on this front. Suddenly we see a lot of emphasis being given on pump storage. L&T itself is doing 2 pump storage in the market today, in India today. And there is a lot more clear focus by the government also in projects that are coming up. We ourselves have nearly 1,000 megawatt hour of projects, nearly about 750 megawatt hours of projects lined up in India for storage battery coming up. So it is picking up. So the way we see within 2 to 3 years, this coupled with the fact that the battery prices across the globe has come down, the way module prices has come down, it is coming to a level which will make it very viable. There will be a lot more push on to round the clock sort of energy requirement, which will require batteries also to come up in a big way. So I think this will pick up. This is a trend in India. Abroad, we suddenly see standalone battery packages coming up from the clients who wants to put 2 to 3 gigawatt hour of battery at a single place to ensure that these solars are, it has got a smoothing on the solar thing and the night time. So this is 100% sure that it will pick up. This along with pump storage would be the long-term way the government is looking at it. And this is happening here in India also today.
Okay. Well, at the moment, the UAE Crown Prince is in India for talks, and the CEPA is being reviewed. They've also signed up even for nuclear projects in India. Is there any headline from Larsen in these conversations? Are you all picking up more projects?
Abu Dhabi and UAE has been a pretty large ground for T&D for L&T. We have been doing multiple jobs across Dubai for Deva, Abu Dhabi. We are now just starting a 400 kV large substation for them. We are doing the solar park of 2 gigawatt in Deva 6 going on. So for us, UAE has been a very important marketplace for Larsen & Toubro in T&D and in renewables. And the way they have a very progressive outlook. We are very sure that the next 5 to 8 years, there are going to be huge amount of business for us there.
Okay. For one moment, just don't wear your utilities hat, but wear the overall L&T board member hat and tell us, would you all want to increase your either order book guidance or your margin guidance for the full year, going by the increased interest?
I think at this stage, we will be a little cautious in changing any numbers, because I think the first 6 months decides the trajectory on how we will go. And I think it's a matter of few more months that we will be coming out with our market analysis, and we will be giving that to the market.
Oh, yeah. I guess in 6 weeks, you will have your second quarter numbers. We will wait for that. Thank you very much, Mr. Madhavdas, for giving us an idea of L&T's renewable energy plans and the reasons for the carve-out. Thank you very much for sparing time with us.
It was a pleasure talking to CNBC and to you, Lata. Thank you very much.
Okay, so that's the word coming in from Larsen & Toubro. The reasons for the special carve-out is not listing, which is what the market was interested in, nor is it lower margins, as some of the pessimists were putting it. It's simply because it has become a very big business and they want to give it special attention. That's the word from Larsen & Toubro. Thank you very much for watching this edition of Bazaar. Time for a break and then Chartbusters.
We have nothing, huh?
No, it's a wonderful walk in the park.